Okay, let's now select the period I'd like to get the past, the average of the 6 months before the valuation date in order to normalize this data, because let's say that the spot date of the treasury at a specific date might not be so reliable. So from February, from March 2023, March, the end of March to the end of September, Okay, apply. 21-23. Okay, let's now download the data. Let's open the Excel and you get something like that. Let's go back to our model. US company, January 2023. Okay. Let's now import this file data and debt or equity Damodaran. Actually, sì, sorry about that. Sì. Alt ESV, not EST. Okay. The industry is always the same. Computer and peripherals. Okay, so we have leverage beta of 1.29. Let me just close this. I can close this also. Okay, so we do the same that we did for the cost of debt, which means format control, range, component Damodaran, cell link is this time C5. C5, perfect. Okay, so for the Damodaran, we have a beta of 1.29. About the company, we have, let's go yo, summary. We have a beta of 1.26. Okay. 1.26, perfect. Yeah, basically the same. Plus choose. Okay. Company and then Damodaran. 1.26. About the debt over equity, oh, Damodaran, bet, and the bet of Apple. Okay. Let's now Apple and Damodaran. For the debt over equity, about Damodaran, okay, 9.52. For Apple, the market cap, I wouldn't say the equity on the balance sheet instead of the market cap. The equity book value is this one, and the net financial position is, let me make that is this is less than 0, then gives me 0, otherwise gives me this one. Okay, so we have full equity structure. Choose. Okay, company Apple for the something like that. Let me go with the modern. Okay, about the alpha factor, which is generally a sort of mm, other risks added, to the cost of equity, related, for instance, to the dimension of the company, for the business plan of the company. Maybe, I mean, there are different ways to define it, and then probably to do a video about the weighted average cost of capital, because I think that this is extremely important. So in this case, it's 0. Cost of equity is risk-free plus market risk premium times the beta levered times the alpha factor. Okay, actually, we do not need the debt over equity because we're just getting the levered beta. Okay. For the cost of equity, I mean. Okay. The formula is 1 divided 1 plus this. Okay. 1 minus this one. So net cost of debt plus mm, there is something wrong. If I go with the company, it is 3. Uh, Maybe I made a mistake. Probably. Yeah, now this sounds better. I do the day over with it. Not HP. Not 0. Okay. Okay, this sounds reasonable. Even if I think that the 9.6% as WACC is a bit higher for a solid company like Apple. So in my opinion, mm, reasonable WACC for Apple would be probably between 7.5 and 8.5. But I mean, these are the numbers, so let's remain stick to them. Okay. Okay, so about our implicit price, I think that there is a problem with the uh, numbers. Okay, because this is in okay, under 0.3. Okay, good. This case we're having an underpricing difference. Okay, so basically the share price, like the market share price at evaluation date is higher than our implied share price. Okay. And I think that the reason is probably because the weighted average cost of capital is, in my opinion, too high. This is obviously not a financial recommendation. About the surplus asset, okay, let's make it dynamic with this way, which means that plus if this is equal to yes, then it's not working. Obviously, why not? It's not working. Oh, I don't know. Excel doesn't work. I hate when it doesn't work. Mm, try another way. Let me try in this way. Let me try. Let me try. Okay. Okay. So now it's work perfect. If it is equal to this, I give it green. Okay. Let's now do the same for E. Obviously, you can do sensitivity table for whatever variable you want. For instance, you can do the same instead of the usually you can use the bit reduction or I mean whatever you want. Okay, ATVT. Let's now this and this one. Okay, and okay, so it works. Okay. F is equal to this one, then gives me 3. Okay, so as I told you before, in my opinion, probably the proper weighted average cost of capital for Apple would be between 7.5 and 8.5, which would return us an implied share price of Apple of something around 107, which is quite close to the share price at evaluation date. I was also looking at the chart of Apple, and in my opinion, let's see if we can see something, but as you can see, this chart probably, okay, let me go to trading view. Maybe here it is more clear. It's more clear. Okay, so as you can see, okay, I already have Apple. Mm, this is monthly candlestick. As you can see, consider that we are basically here, June, August, September, October, November, December. As you can see, price at the end of September 23 comes after a solid increase of the price, the market price of Apple. So in my opinion, at the moment, it could be a bit overvalued. And so this is basically the model. I hope you enjoyed it. I mean, here you can sensitize and create scenarios about whatever variables you want. So it is quite I'd say that it's quite professional, this model. And if you have any questions, obviously leave a comment below. And if you want to, there's a specific topic that I would like that you would like me to deepen in the next videos, please leave a comment below. And I think subscribe to the channel if you enjoyed the video. And I mean that's it. So bye.